Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance right here at our Bloomberg World headquarters in the beautiful Midtown Manhattan. So at the top of the hour, Federal Reserve Vice Chair Michael Barr commented in a speech in Washington, and this concerns Basel III endgame capital rules for banks. And he made some material changes to those bank capital proposals. The biggest banks are now going to face just 9% capital increase after some revisions, and some smaller banks will be exempt altogether. Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now to go through all of this. Okay, so if I'm a JP Morgan, I like this?
You like it better than what you had before. It's still higher than they would like to see. And it's sort of a compromise from the Fed and the other regulators. Now, Michael Barr also noted that this hasn't been completely finalized yet. They're going to hopefully propose it next week. And then it has to go through another comment period. And he noted that the other regulators haven't signed off yet. But this is likely what we're going to see. The 9% is still a fairly hefty additional level of cushion against financial shocks for them. So it is better than the 19% that had been in the original proposal. And then the medium-sized banks, the 100 to 250 billion, they won't see any change in any additional change in their capital requirements, with the exception of capital held to maturity, the stuff that got SVB in trouble. If yours isn't in good enough shape, then you'll have to pay a bit more.
Is this still from the Great Financial Crisis? All these rules here? Is this kind of, I mean, are we done yet? I mean, come on, enough's enough.
Maybe after Endgame? Maybe this is why it's called Endgame.
Well,
I'm kind of with Jamie.
That's the laugh. Marvel, the Avengers movie series did a movie as a two-part movie called Endgame, which was supposed to be sort of the end, wrapping up all these threads over the years. And now they're doing more Marvel superhero movies. So Endgame is not going to be the Endgame. There will always be something that comes up. But this is a process that's been underway for a very long time. Basel process started back in the 1990s of trying to harmonize international banking rules. And this Basel III process came after the great financial crisis. And they're trying to harmonize and agree on safety standards for banks around the world. And that goes a lot deeper than just capital. It's what kind of models they can use. In this case, they're going to have to switch from using their own models for risk to standardized risk models, stuff like that. It has a major impact on how the regulatory offices in these banks will operate.
All right. Michael McKee, thank you so much. We appreciate it. Michael McKee's our economics dude here for Bloomberg Radio and TV. JP Morgan stock down 4%. No idea why. Aren't stocks?
Well, we also have some, the big banks are all talking right now. So Jimmy Pinto over at JP Morgan is saying that third quarter investment banking fees could rise about 15% from a year ago. Not a big fan of acquisitions and asset management. David Solomon, Goldman Sachs, spoke yesterday at a conference talking about their trading revenue. So we're getting all that feedback right now. So
all right,
putting that out there.
It's September, which means it's conference time.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So today, the EU's top court delivered two final binding rulings against two U.S. tech companies. Apple lost its court fight over a $14.4 billion Irish tax bill, and Google lost its challenge over a €2.4 billion fine for abusing its market power. EU Competition Commissioner Margaret Vestager spoke to Bloomberg following the victories for the European Commission, and she said she hopes her record shows she was willing to take the risks to prove that the market works for consumers.
You need to, of course, own your victories, but you also own your defeats. And we've had both. And hopefully that shows that we're willing to push the envelopes, also sometimes to take a risk in order to try to make sure that the market serves the consumer and that we are not just small pawns or meat for the machine. And I hope that is what people take down from today's judgment, both that we won the Google case and it's final, and we won the Apple case and it's final.
That was Margaret Vestager joining us. All right, let's get more insight here with Tamlin Bason, Bloomberg Intelligence technology analyst who joins us on this. Was this at all surprising to you, Tamlin?
No, this wasn't terribly surprising, Alix. The Apple tax case, we start with that. In 2016, the European Commission made this finding. It assessed a $13 billion penalty, which was basically what it said were unpaid taxes because the Irish tax authority had given these favorable opinions to Apple that essentially amounted to improper state aid. Now, what was interesting is that the Intermediate Court in 2020 did reverse that decision and said the Commission didn't follow certain guidelines in setting that fine. But when we looked at the briefing going into this final hearing, it did seem like this was going to be the result. So I think this $13 billion verdict against Apple wasn't entirely surprising. And this money has been held in escrow for a number of years. So I think people sort of saw this coming this way.
So, I mean, is this just another, I guess, hurdle that Apple and other big tech companies have to deal with from a regulatory standpoint just all over the world here?
Yeah, I mean, the hurdles are certainly stacking up. But I think what's interesting about this is I look at these two decisions as really some of the last ripples from really regulatory actions that began kind of nearly a decade ago. And I think now we've certainly moved on especially in Europe, but also in the US, there are increasing hurdles there that the companies are having to face. I mean, especially if you look at Google, and it's sort of locked up in another trial this week with the DOJ over competition concerns. So these challenges really are mounting up around the globe.
So put it all together. So I guess that's a great point. What's on the docket court-wise for big tech in Europe? And then what's on the docket big tech-wise in the U.S.? And do you have like a spreadsheet that sort of outlines everything? Because I honestly can't keep track. And also like what the money is associated with all of it.
Yeah, we've got quite a few spreadsheets. I do have one where I track all the ones that are in Europe. And if you look at Europe, why I say that we've moved on from that is because after these regulations, these litigations were started 5, 6, 7 years ago, what the European Commission did is they went back and they rewrote some rules where they said, we're going to make it easier to really go after some of these anti-competitive practices that we're seeing. And that's why we have the Digital Markets Act. That's why we now have the Digital Services Act. And we already see under the DMA that there are some probes facing both Apple and Google. Google for sort of similar practices that were at issue here, where it was alleged to have abused its dominant position in search to elevate its own products over the products of peers. It's already facing investigation for that. Apple's facing 2 DMA probes, both related to the App Store. And I think these ongoing have probably more of an operational risk because they really could go to how these companies are currently operating, not just sort of this backwards-looking financial penalty thing that we saw today. Then if you look at the U.S., of course, I think the biggest thing facing Google right now is this DOJ lawsuit that is going to trial this week based on its ad stack. So I think that could have some really profound ramifications for the company, not just in terms of financial penalty, but really behavioral remedies, which is, I think, moving forward, what could be the most threatening thing for a lot of these companies.
Tamlin, is the UK view of big tech different than the EU? And the reason I ask is now that obviously the UK is out of the EU. Do they look at tech any differently than the European Union?
Maybe there's some slight variations where they maybe trend slightly more toward the U.S. Although I say that, but the U.S. now is really fairly aggressive in their stance on big tech. But the UK doesn't really quite have the competition rules, but they also are saying that we're going to reevaluate how some of these rules are going to be applied against these big tech firms. So I think it's difficult to find any real safe haven in terms of a regulatory standpoint for these big tech companies, whether it's EU, UK, or even increasingly the US.
How do you handicap all of this within, say, valuations or how you model the stock?
I honestly think a lot of investors have a little bit of regulation fatigue when it comes to this. This is by no means a new story, especially if you look at how the EU has been going after these dominant firms for over a decade now. And I can't say, when you look at them, you can see really a loosening of their grip on the markets here. So I do think in many ways that investors are sort of shrugging off these actions. And I think, especially when you look at the increasing trials that we're having, that we actually could see some huge sort of landmark litigations coming out. So it's definitely something to keep an eye on, even though we've been seeing it for years and years and years.
All right, Tamlin, and Apple stock down about 0.8%. Tamlin Bason joining us, Bloomberg Technology, a technology analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele, Paul Sweeney, live here in our Bloomberg Interactive Brokers studio. We're also streaming live on YouTube as well. I've been a loyal BMW customer for probably, 25, 30 years. Currently driving the X3, which is the best vehicle I've ever driven, period. Not a good day, however, for the stock of BMW, down 11% today. That's the most since March 16th, 2020, just the beginning of the pandemic, and it's the lowest since 2021. So tough times out there for BMW. Let's get the latest of what's happening with them. Micheal Dean, head of global autos at Bloomberg Intelligence, joins us from London via Zoom. Michael, what's going on with BMW today? I saw that they took their earnings forecast down. What's driving that?
So BMW had a profit warning today, and that was partly on the back of a warranty issue it has with its brakes, not on the X3, so you're fine, Paul.
Good, no problem.
But they're going to have to recall 1.5 million vehicles, and that's going to cost a high three-digit million in terms of earnings for 2024. But that doesn't tell the whole story, because they've downgraded their margin by about 200 basis points, which is about 2 billion of EBIT. So the balance of that is coming from weaker China sales, lower pricing in Europe, lower demand in Europe. So just the demand and pricing environment globally has been very difficult, and that's part of the reason for the profit warning.
Which then leads us to Volkswagen. So the latest news today is that it's ending its job protections for auto workers in Germany as part of its cost-cutting push. These were several agreements that were linked to a 3-decades-old pact that was supposed to safeguard employment until 2029, but now those guarantees are going to run out by the middle of next year. I mean, wow.
Yeah, so, Volkswagen was in the news last week because it said it needs to close 500,000 units of capacity in Germany. So that's very difficult because of workers' rights. And, workers' rights have been very one-sided for Volkswagen in particular, because you have VW law. And this is where 20% of the ordinary shares, the voting shares, are owned by the state of Lower Saxony, which is where Volkswagen's biggest factory is. And funnily enough, they have the ability to block certain agreements. So workers' rights are very strong for Volkswagen employees. And now I think management are saying, okay, hold on a minute. The automotive world's changing rapidly. We need to do something to reduce costs. And part of that is to close factories and reduce jobs.
Michael, give us just a 30,000-foot view of the global auto business here. I mean, the weakness that you're seeing in Europe, the weakness you're seeing in China, is that just general economic weakness affecting that we've seen in past cycles, or is this something to do with this ongoing transition to electric vehicles?
Yeah, it's a bit of both. So, you have the transition to battery electric vehicles. It's going much slower than expected in Western markets. Other markets probably going quicker than expected, such as China. But the problem Volkswagen has is that the competition is so intense and has overtaken them in China, such as BYD. So Volkswagen a couple of years ago was the market leader in China. Now BYD, within 2 years, has overtaken Volkswagen. And really, it's going to be a survival of the fittest in these markets.
Well, I mean, these companies aren't going to go under or anything, right? So I guess I'm wondering when the trough is. When do we know? What is a trough actually going to look like?
Well, you say, a lot of companies could go under, particularly the pure play battery electric vehicle companies.
Sure, but I mean, I just meant that Germany's not going to let Volkswagen go bankrupt, was my point.
No, of course. And the interesting thing, if you look at the valuation of Volkswagen, today it's valued at 45 billion euros. I've had a lot of clients talk to me about this today. They have almost 40 billion of cash on the balance sheet. Their 75% stake in Porsche is worth 45 billion euros. They own Lamborghini brand, which has higher profitability rates than Ferrari, which is currently valued at 77 billion. So we think Lamborghini's worth 30 billion if you use a Ferrari valuation. So the sum of the parts is Volkswagen is huge compared to the actual valuation at Volkswagen at the moment.
So you highlighted an area for me that just kind of feels like a long-term issue, which is China. I mean, they spend decades, they being any auto company, Volkswagen, BMW, Mercedes, whatever, building brand value and brand loyalty in a market like China. And in a period of 2 years, they've lost that, it seems like. I mean, is that the real bearish case for some of these global auto companies?
It's a big case. So for the German automakers, in the past few years, China was the most profitable market. It accounted for 35-40% of their profits. Now this year, it could be as low as 10%. And what the market's pricing is that could be zero in the future. And that's because the technology changing and the way that startups in China are pushing through so quickly. They're really fighting for market share at the moment and their future.
So then it goes back to my question. What does the bottom for either U.S. car companies or for European car companies wind up looking like as the tariffs go into place, as China keeps producing these really cheap EVs, as we have different restrictions here in the U.S.? Like, what is that?
Well, you look at what GM and Ford have done. I mean, GM in particular, it's looked at different markets, and if it's not profitable, it's pulled out of those markets. Right. So China is one example, Europe's another example. So it's whether the German automakers take a view that can they be profitable in China in the future, and many foreign car makers are saying no. Volkswagen at the moment is saying yes, we can, and they've got this long-term plan, and they've invested in XPeng to hopefully accelerate their transition. But it's going to be very, very difficult for foreign car makers to continue to make profits in China.
So, I mean, again, it feels like, is there even discussion of whether they should be there at some point?
Certainly within the market, but for the company itself, that they've invested heavily in China, and they've got a plan now to try and catch up with local producers, to catch up with BYD, which is with this partnership with XPeng. So they think they've got an opportunity because they've got a good brand in China, but it's going to be very tough. I mean, pricing in China is really, really competitive at the moment, to the point where battery electric vehicles are actually priced below internal combustion engine vehicles. Wow. Compared to that to Europe, where the average battery electric vehicle is 35% higher than a ICE vehicle, and they still can barely make a profit in Europe. So that's it's a very tough environment.
Yeah, so then they'll have an EV factory there, but then all of a sudden you're looking at potential losses then for workers in actual Germany. All right, really interesting story. Yep. Thank you very much, Micheal Dean, joining us from Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It's September, which means it's conference time. It's also time to talk about the hedge fund business. I'm not buying it per se. I'm not a fan of the hedge fund business. I think that model's broken. I think it was broken in the mid-2000s. That's just my personal opinion. Donald Steinbrugge joins us here. He's founder and CEO of Agecroft Partners. I know the term Agecroft. That's from Richmond, Virginia, and that's where he's based, down in Richmond, which is one of my all-time favorite towns. My twins were born there. I went to school down there. Great town. Don, I think this whole hedge fund game's a scam, but tell me about what's going on in the hedge fund business in terms of, can people raise capital? What's the state of the hedge fund business these days?
Well, first of all, it's great to be back, and I think it's probably going to take a couple more interviews before I finally get you to buy into hedge funds, but it's going to happen. You're moving, a little bit each time. Hedge fund industry is pretty strong. I started in the industry in 2001. It was $600 billion industry. It's now $5 trillion. The market is pretty saturated, meaning when you look at who's invested in hedge funds, pensions, endowments, foundations, sovereign wealth funds, the ones that are going to invest in hedge funds tend to be pretty fully allocated. So you're not really seeing growth from an inflow standpoint. As a matter of fact, you've had a little bit of money come out of the industry. But the industry has grown significantly because of performance. For example, year to date, the hedge fund industry is up 7.5%. In addition to that, it's a great business to raise assets because you have huge divergence in performance between strategies and managers. There's always people getting fired. Average person owns a hedge fund for 5 years. It means 20% of the industry turns over, $1 trillion to be had. But it's still difficult because 90% of assets are going to 5% of managers.
Wow.
So what kind of strategies work right now?
Well, the one with the biggest demand right now is long short equity. And long short equity went through a really...
Paul's laughing at you right now.
A really long period where people just hated it. I mean, last decade, money just kept coming out and their performance was under the S&P 500 over and over and over again. And a lot of people said, hey, you put all your money in the S&P 500. And what has that done? It's driven the S&P 500 to an extremely high valuation. It's dominated by a small handful of stocks. And the reason people like long short equity is some people are worried about the market. If you're worried about the market, be hedged. If you're not worried about the market, go all in. Other people like the fact that there's huge divergences between valuations, between value, growth, small cap, large cap, U.S., non-U.S. And over time, these divergences have contracted. So it means a lot of people think fundamentals are going to add value. And the last thing is you can make money on the short book in your portfolio because short-term rates are high. You might get another 2% return based on the interest on the short book.
You mentioned that most of the funds are with a relatively few managers, the Citadels of the world. How did that come about? I mean, it used to be a day where if you had a hotshot trader at Morgan Stanley or Goldman Sachs, you could go out and raise $500 million or $1 billion. That's not as prevalent today, is it?
It's not, and I will say that is one of the big issues with the industry is a lot of people buy brand. They think, there's safety in brand. A lot of these top managers had phenomenal track records a long time ago. They're managing way too much assets. Their returns have been very mediocre for a lot of famous hedge funds. A lot of these pods have done very well recently, but they've gotten very large. Mm-hmm. You're beginning to see some money focus more on smaller managers. Smaller managers, if you want good returns, is where you want to invest, but you don't want to invest in them unless you understand the inefficiency that they're focusing on and what their differential advantage is to capture that inefficiency.
Mm-hmm. What about all the main strategies like volatility-focused funds, CTAs, like the trend followers? What's the interest there?
So there's been a pickup in interest for commodity trading advisors, and basically they're people that invest in financial futures across the four main capital markets, and they're quantitative managers that are looking at price patterns historically, and they tend to do very well during market sell-offs. So they help protect markets if the market's going to sell off, help diversify. A lot of people are worried about valuations of the equity marketplace, so that's one way to diversify away from equities.
How about pricing, fees? Is 2 and 20 still the game?
So is this why you don't like hedge funds, because of the fees?
Yeah,
no, I love the fees.
So
he likes the fees.
But if I were managing money, I just don't think that fee-adjusted returns are worth it. Anyway.
People need to focus on fees, and fees have come down a lot. The prominent managers, you pay 2 and 20 for performance that might not be, that great because now they're really large. But new managers, smaller managers, typical fee is probably 1.5 and 17 performance fee, potentially less. It's also diverted between individual investors and institutions. A lot of people listening to this radio broadcast may indirectly own hedge funds through their government pension fund or corporate pension fund. Big institutional investors, on average, are probably paying 1 in 10, maybe 1 in 15. So huge contraction. Also hurdles. Hurdle is for performance, and a lot of people don't want to pay a performance fee on cash, so they're saying, hey, you got to beat cash before we're going to pay a performance fee.
Well, this is my other question, and this may be a really ignorant question, but with the dominance of NVIDIA and the Mag 7, how does a hedge fund compete against that? Because at the end of the day, wouldn't they do just as relatively well, just buying the index or buying
I
stocks?
guess it all depends whether you think that those companies can continue to go up the way they've gone up. A lot of people.
But we have to wait for the Mag 7 to sort of fall out for then those hedge fund strategies to pay off. Is that the idea?
I just don't think you can. I don't think you can time it. And if you think that the equity market is overvalued, then you don't want to wait until certain things happen and then change your portfolio. You need to change your portfolio before it happens. And so one way is to hedge it. Another is you could also overweight certain factors through mutual fund index funds if you wanted, underweight the S&P, overweight other types of indices that are cheap from a relative value standpoint to the S&P 500.
Real quick, 30 seconds. Has the growth in ETF, is that taking funds away from hedge funds? Or is that the ETF growth just come from mutual funds maybe?
Yeah, I think it's come from mutual funds. I think it's come from, long-only managers. As I mentioned, the hedge fund industry now is a little over $5 trillion. Wow. I think it's, again, fairly saturated, but it's growing through performance. And, the environment for a hedge fund manager is good if you're really good, and if you're not really good, it's a very difficult market to be in.
Yep.
All right, Don. Life.
Yep.
There's a life lesson there.
There is, exactly right. Donald Steinbrugge, he's founder and CEO of Agecroft Partners, joining us live here in our Bloomberg Interactive Broker Studio. Give us an update on the hedge fund business. Again, $5 trillion, just extraordinary there, and there are obviously some big names out there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Deal here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. Let's check in with one of them right now with Nathan Dean, Bloomberg Intelligence Senior Policy Analyst. Yeah, shocker, there's a debate tonight in case no one's been paying attention. Starts at 9 p.m. We'll have special coverage here at 8 p.m. simulcast on radio as well as television. Nathan, though, from an equity side, is there a Harris or Trump trade evolving at all that we can sort of zone in on?
No, I don't think exactly. I mean, anytime you talk Trump trade or Harris trade, we really just, there are certain sectors you can say will impact in certain ways to the presidency. But I think for tonight's purposes, we really want to hear more about tax plans. We want to hear more about economic plans because, both candidates have been fairly light, over the past couple of weeks in terms of saying how they're going to actually change certain things. Now, obviously, for tonight's debate, we've heard President Trump say that he wants to cut the corporate tax rate down to 15%. Kamala Harris, the vice president, wants to go up to 28%. But we would always just caution our clients and investors and so forth like that. Just remember, every statement that comes out of the candidate's mouth, you have to remember how they're going to get that through Congress or how they're going to get that through Washington. And for a lot of these tax proposals that you're going to hear tonight, the other folks down on the other side of Pennsylvania Avenue, the Congress, they may have different plans. So it's just interesting to hear those thoughts. But most likely than not, they're going to have to be curtailed or restricted some.
Should a question be asked tonight of both candidates? Talk to us about annual deficits. Talk to us about the total debt of the United States. Should that be a question?
I think it should be. I mean, this is something that we get from New York a lot, especially from asset managers that are concerned with the state of the U.S. debt. But from the Washington perspective, the U.S. debt is not something that many people have thought about, or at least if they are thinking about it, it's certainly not reflective in what Congress spending goals are. So, I think when it comes to the debt, though, however, it's really going to be whoever wins the election, because if Kamala Harris wins the election, you're going to have a return of the debt ceiling fights that we saw under the first half or the end of the Obama administration, where, debt ceiling comes up, it's going to be negotiated, and then ultimately when the markets begin to react to it, they kick the can down the road. Now, the debt ceiling doesn't expire until January 1st, 2025, which is good news because the lame duck, and it will probably be one of President Biden's last signature as president to kick the can down even more. But if President Trump wins, I don't think you're going to see many of this debt ceiling fights at all.
What about some of the sectors, the key sectors that are kind of most exposed here?
Yeah, so, we just put out a large report on the Kamala Harris versus Donald Trump race. And some of our key sectors to watch were like renewables, tied to the Inflation Reduction Act. There's a lot of tax carrots, if you will, in there that are spurring renewable investment, especially in CapEx in a lot of GOP states. Others involve the banks. The Basel III endgame, a proposal that would increase capital requirements around 9% for the investment banks. If President Trump wins, that may not go forward. Other things are global manufacturers due to the tax changes that we just talked about. Healthcare, there are $25 billion in Obamacare subsidies that are up for renewal next year. And finally, big tech. If Kamala Harris wins, you're going to have a continuation of the very stringent M&A antitrust authority that the Biden-era regulators are putting on big tech. But if J.D. Vance's idea of economic populism gets into the White House, you could see a Republican president also be very skeptical of big tech. So a lot of what ifs, but a lot of scenarios in which those industries could be heavily impacted.
I listened to former President Trump's economic plan at the Economic Club of New York. I don't know. I had a hard time making heads or tails out of it, but I guess it was lower taxes, higher tariffs. Is that kind of the basis of his economic, platform?
Yeah, I think that's a really good point to point out, because I think it's almost like a phase 1, phase 2 type of deal if President Trump wins. Phase 1 is tariffs. This is something that he can do. The power of the presidency is a lot more powerful there. And so, the first half of 2025, you could see a lot more tariffs coming in. Now, I would argue that a lot of these tariffs are negotiation ploys. If he holds up an executive order and says, I'm going to sign a tariff, there's probably language in that executive order saying 270 days from now, it won't go into fruition until then, because you're going to give the opposite side multiple times to negotiate. But it's certainly something that he's comfortable with, and I think, would easily put out if he feels that it's necessary. But then the tax reform debate is what's going to come next, because at the end of 2025, those Trump-era tax cuts for individuals expire. Now, President Trump has said 15% corporate tax rate. I'm not sure he'll be able to get that. He's going to have to negotiate. We've seen a little bit of statements from House Republicans saying, maybe we should go down to 20 or 19 or 18%, but being able to pay for that 15% is going to be somewhat difficult for these deficit hawks. So, but there's a lot of provisions of the Trump-era tax cuts that have already expired for industry, and I think President Trump is going to try and institute those. So at a large level, think Trump 2.0 is going to do another version of the same tax cut.
I literally remember having the exact same conversation in 2015, 2016, like the phase 2, how you get it done, etc. So what's interesting to me, though, is the lack of response, though, in, say, high tax companies versus low tax companies, like the things that would make sense because those policies are so different, say on corporate taxes. Are we seeing that reflected within market moves?
I think so, but I've been talking to a lot of investors over the last few weeks, and a lot of folks come to me and they say, we just really don't know what's going to happen on tax until we know the makeup of Congress. And the reason being is that if President Trump wins, but the Democrats take the House, pretty much all of his tax vision, if you will, is going to be curtailed, negotiated, and a lot more restricted. Now, if he ends up winning the House and the Senate, they can use reconciliation to essentially bypass the Democrats, and they have a very broad net that they can cast. So a lot of people that I've been talking to have saying, look, we understand the Trump-era desires, and we understand that these broad deficit-inducing tax cuts potentially could be on the horizon, but we're not excited about it just yet because we need to see how the House and Senate races play out.
What is the thinking currently in Washington, Nathan, about how that will play out in Congress?
Well, look, if you go to the function on the terminal WSL election, you can see all the data there. But I think, when it comes to the Senate, that's going to be somewhat very difficult for the Democrats to control, because right now it's 51-49. You're going to lose West Virginia because Senator Joe Manchin is retiring. So now you're at a 50-50, and the Democrats essentially have to run the board just to keep that 50-50. Think of Senator Sherrod Brown in Ohio, Senator John Tester in Montana, Senator Jackie Rose in Nevada. So assuming that if the Democrats lose one, the Republicans are most likely going to take the Senate, and if President Trump wins, then obviously allow him the ability to put in judges and his regulatory leadership. When it comes to the House, I've seen polling on both sides, but my general view, and this is just my personal view, is that whoever wins the president also wins the House.
Oh, okay, interesting. How excited are you for tonight? Is this like a Super Bowl for you? Like, do you get popcorn? Do you have like guac? Do you have avocados? There's an avocado debate happening right now on radio and TV.
I think I'm going to try and take as much Bloomberg popcorn away from the pantry I can home with me tonight. So nice. It's going to be a fun night.
That was awesome. All right. Hey, Nathan, we really appreciate Nathan Dean, Bloomberg Intelligence, Senior Policy Analyst, and the most recent deep dive on the impact of the U.S. election. It's one of those things, it's one of those things where it's like I want to cringe, but watch it. It's like you want to watch it through your hands, like a scary movie or something, because you just don't know like what's going to erupt and what's going to happen. Yeah, and again, as Nathan was just pointing out, this research report, which you can get at BI Go, is just really in-depth, basically just saying from an economic Wall Street financial perspective, under two different presidencies, which industries are winners and losers. So it's great research. BI Go on the terminal, and that's where you can find it. Good stuff.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk about the broader markets. One of the things we like to do is get a sense of what is investor sentiment out in the marketplace. It's one of the factors that Gina Martin Adams from Bloomberg Intelligence factors in. And I think if you want to do that on the retail side, nobody better than talk to than the folks at Charles Schwab, because they've got like a gajillion customers out there. Joe Mazzola joins us, head trading and derivative strategist for Charles Schwab, joining us here in our studio. He's based out in the Bay Area, but he joins us here in our New York studio because why wouldn't you be in New York if you're in a financial services business? That's what I say. Talk to us about your STAX index. What is it, and what's it telling you these days?
Yeah, hey, thanks for having me. Appreciate that. And the STAX index, what it does is it measures our Schwab trading activity index, or it measures our Schwab clients. What are they doing? So it's the behavior over the attitudinal. Basically, what we do is we look at 32 million accounts. We take a little subset of that and say, cool, were we buyers or were we sellers over the course of the month?
And what'd you learn?
And there was a little bit of selling in August, so it basically pulled back a little bit from what we saw in July. Still above levels that are above moderate, but for the most part, we did see some selling. And what I would say is this: it was almost a tale of 2 months. So, beginning of the month, we saw clients kind of step in and buy that dip from the August 5th sell-off. Saw a lot of activity in AI stocks, a lot of buying there. But as the month kind of trailed on, what we saw was a little bit more of shifting towards away from equities and into fixed income.
All right, so this index typically ranges between a reading of 35 and 70, yep. And then I guess the reading for August was somewhere in the 53 range. Correct. So it's kind of right in the middle there. Does that kind of suggest to you that your clients are neither overly bearish or overly bullish?
So we always follow that up with an attitudinal study as well, too.
Okay.
So we have the behavioral study that we're talking about now, but we always like to do like a trader sentiment study where we actually ask the clients, how they feeling about going forward. And what we found out is that they're still feeling moderate to positive, kind of as they're heading into the September month. There's a little bit of concern around interest rates, so that's giving them a little bit of a pause in terms of what the Fed action will be. We're hearing a little bit of concern in terms of the political cycle and what the elections could do for the markets as well. But overall, yeah, Paul, you're right. I would say for the most part, they're moderately bullish.
What are they buying? What are they selling?
So what we saw on the buy side is some of the typical names kind of rose to the top, NVIDIA being one of them. Amazon is new to the list. It's been off for a little bit, so that one came back. One of them that we haven't seen, I was shocked to see this one, was Intel. And I think part of that, is just because we got about a 30-35% pullback, right, off of earnings. And we saw some dip buyers kind of step in. On the sell side, what was interesting about the sell side is these were a lot of the names that kind of flip-flop between both sides. But what was interesting to me is out of the Mag 7 names, you had Meta and Apple. And if you think about kind of how those stocks performed relative to the other ones, they actually held up pretty well throughout the month. I mean, Meta even put in a 52-week high. So I think what we saw was some profit taking, maybe from some of the dip buying that we saw earlier in the month. And then the last one was Starbucks. And if you remember, Starbucks has a new CEO, came over from Chipotle, got a nice little pop there, and we saw some clients trim some profits after that occurred.
Yeah, interesting. I mean, the stock, remember that day was up at 18% just when the news, which
that must feel really good. Like you leave a job and everyone's like, let's buy that stock.
Exactly. One of the sectors that was most pronounced in buying was energy, which is interesting because we were just talking to Mike McGlone, our commodity analyst, so we were just talking about the decline in oil prices, but maybe some of your clients are seeing value there, maybe.
I think that's probably what it is, Paul. I think you're right. I think that there's some dip buying in there, looking for some opportunities. What I found interesting as well, too, consumer discretionary was another sector where we saw some buying. I think a lot of that has to do with the Amazon, the Amazon buying that we saw. When you look at the sectors that were sold, a couple of rises to the top there, and communication services being number one, a lot of that has to do with some large sales in Meta in there as well. When I look at kind of what our clients did relative to where maybe we saw some of the rotations in the market, I think it's interesting because the breadth, right? Where we saw kind of a breadth thrust would have been more on the interest rate sensitive sectors, financials, right? Utilities, REITs. Didn't see a lot of retail movement into that. So to me, that says it's a little bit more institutional buying there.
Here's an unfair question. How do you feel like retail's looking at the election?
Well, I don't know what side they're picking, but I know that.
Yeah. But in terms of like, do you see any hedging? Like,
yes,
yeah.
absolutely. No,
okay.
absolutely.
And how are they doing it?
Yeah, so there's a couple different things we're seeing. We're seeing it on the broader side, and I don't know if that's retail or if it's institutional, but you're definitely seeing some put buying in the SPX, and that's kind of pushing up the VIX a little bit. You're seeing the skew kind of get bid up a little bit more, the difference between the puts and the calls and the 25 deltas. So we're starting to see that as well. We do see that on the retail side. I love to say that our clients are educated. I mean, we have a lot of educational opportunities for them. A lot of them utilize options in their strategies, and we're starting to see more and more activity on the option side heading into the elections.
Do you see your clients, do they trade around events like we kind of think that they do,
Sure.
whether it's the Fed day or jobs day? Do you see like a spike in volume, a spike in trading? Does that happen on that platform, or are your people just... I'm holding.
Well, I mean, I think you have to look at it two ways, right? You have the investor base, and then
Yep.
you have the trader base, and a lot of that trader base came over from the TD Ameritrade acquisition.
Oh, right.
So they are pretty active clients, and they love event risk, they love earnings, they love trading around that, different type of strategies. Specifically, Alix, as you were talking about, some option type strategies around there. So yeah, we do see a pickup around those events, and how they hedge it or how they play it, that kind of depends on the client themselves, but we do see activity. Yep.
It's so cool. I love all of this insight. How's retail trading bonds right now?
Yeah, we've seen a rotation into fixed income, and what we're seeing from that side is that they're probably trying to maybe front run the Fed announcement on September 18th, maybe trying to buy bonds before yields come down a little bit.
Is it the front end or the long end? Or?
We're seeing it more in the middle. Yeah, definitely in the middle. Yeah, a little bit of the belly.
ETFs. It's just, I mean, Alix and I have just been amazed at the growth of the ETF business, maybe to some extent at the expense of the mutual fund business. Yeah. How much or how often or to what degree are your clients using ETFs?
Yeah, I mean, think about the flexibility that ETFs offer, right? Whether it's being able to trade intraday on them, not having to wait to end of day settle. You want to use option type strategies. So yeah, that's something that's employed quite a bit by our clients, just because, like I said, the flexibility, and it gives them the ability to have some diversification, choose sector ETFs. That's another thing we've been looking at. And at Schwab, we offer a lot of that thematic type trading, and that is something that we've really seen start to pick up as well too. So clients, they don't have to necessarily pick a stock; they can pick a theme, and it gives them the ability to have exposure to that.
This is a super weird question.
Sure.
We had an article out a couple weeks ago, I think, that said that as online gambling has picked up, you've seen more of that and less actual retail trading. Have you noticed like any correlation of like when you see surges and not for retail, or is it the same kind of volume and stuff that you were seeing back in 2020?
I mean, I would say if you look at the options market as a whole, right? I mean, we're doing, not Schwab, but in general, the whole market's doing 50 million contracts a day. So I don't know how much of that's being pulled from gambling. I guess we'll find out now the football season started again to see if that pulls some of the money away.
Enough.
But at this point, I just continue to see, the options market continue to expand. So I'm assuming it's pulling some of that gambling dollars in there.
So cool. All right, Joe, thanks a lot. Joe Mazzola, Charles Schwab, Head of Trading and Derivatives Strategist. Definitely come back.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.